Outside of tech, there are other sectors that I love for 2025. And today, I am going to share with you an ETF from each of those sectors that could be ready to have a great 2025. Hold on to your seatbelts, folks. This is going to be a good one. Our diverse economy rests on several foundational pillars that have historically offered resilient dividends and steady long-term returns for investors. Among these pillars are, of course, energy, utilities, financials, real estate, and materials. Heading into 2025, the continued global transition in energy usage, coupled with, of course, Canada's robust regulatory environment, well, that puts these sectors in a position of relative strength. Not to mention a changing of the government guard, which will be a catalyst for at least a few of these sectors, if not most of them. We are in a different environment than 2024, as we are starting with lower interest rates with the promise of additional cuts in the year. Lower interest rates generally lower borrowing costs for businesses, which can stimulate expansion and improve bottom lines across multiple sectors, particularly those with significant capital expenditure requirements like energy and utilities. For real estate, rate cuts can encourage more mortgage lending and real estate development, which in turn can benefit REITs through increased occupancy and rising property values. The financial sector experiences a mixed impact, although banks may face a narrower net interest margin if rates drop too far. They can also enjoy higher loan demand and potentially stronger overall lending activity. Finally, lower rates ease capital raising efforts for mining materials and other resource-focused companies, thereby supporting exploration and production projects, which of course can translate into some sustainable dividend growth if commodity prices remain favorable. As such, if continued rate cuts persist into 2025, these Canadian sectors could further consolidate their positions, buoyed by, of course, that cheaper financing and potential upticks in consumer as well as corporate spending. A sub to the channel is the best way to access the future content sector. Normally, I have all kinds of qualifiers that help me narrow down the ETFs. However, in this case, the qualifier was, well, really the sector. Once I had the sector, there were a handful of ETFs I could have picked from, and these ones are the ones that resonated with me a little more than the others. Anyway, without any further ado, let's do this. We will start with an ETF that gives us exposure to the real estate sector, the Vanguard FTSE Canadian Capped REIT Index ETF with a ticker of VRE. They are set to replicate the performance of the FTSE Canadian All Cap Real Estate Cap 25% Index. Their top holdings include First Service Corporation, Colliers International Group, and Canadian Apartment Properties REIT. At the time of recording, their price is coming in at $30.98, and they have a NAV of $30.98. Their assets under management come in at $275.05 million, and they've got a pretty average beta of 1.04. That return on equity, that's coming in at 8.51%, and their return on assets, 3.16%. Switching over to fees, they have a management fee of 0.35%, and that management expense ratio a little bit higher at 0.39%. The average volume on this one is kind of low, 7,119. Looking at their dividend, they have a yield of 2.803%. That is a monthly dividend of 7.8 cents per share. On their returns, their 3-year return on investment, not very good, minus 10.75%. Add in the dividends, we do get a total return of negative 2.05%. Okay, if we look at the last year, we're starting to see some recovery here. We have a return on investment of 2.65%, total return 5.83%. Oh boy, you could definitely see that they suffered through that rate hiking environment for sure. Now, if we look at their 3-year annualized, that is, unfortunately, it's in the negative 0.69%. One of the reasons I chose the real estate sector is that rate cuts are setting up an ideal environment for the sector, which will benefit, if not from only lower servicing of mortgages, but it is also setting up a situation where potential homebuyers are beginning to come back. Moving on to the utility sector, We have the iShares S&P TSX Capped Utilities Index ETF with a ticker of XUT. They provide some great exposure to Canadian utilities as they replicate the S&P TSX Capped Utilities Index. Their top holdings include Fortis, Brookfield Infrastructure Partners, and Emera Incorporated. At the time of recording, their price was coming in at $27.52, and they have an NAV of $27.82. Their assets under management, 368.8 million, and their beta is coming in at 0.63, so they're a little bit less volatile than the market average. That return on equity, 5.78%, and their return on assets, 1.61%. Looking at their fees, their management fee comes in at 0.55%. Their management expense ratio, 0.61%. Their average volume, nice high number, 126,321. When we look at their dividends, they have a yield of 4.055%. That's a monthly dividend of 8.1 cents per share. On their 3-year return on investment, that's coming in at negative 6.30%. Add in the dividends, we do get back into the positive 4.12%. Switching to their 1 year, we get a return on investment of 7.29%, total return 11.62% once we put those dividends in there. Their 3-year annualized 1.35%. Utilities is another sector that benefits big time from a lower rate environment, as they do tend to carry a lot of debt. We have already seen some solid movement to the upside in utilities, and that's set to continue well into 2025. My next pick is in the energy sector, and we have the iShares S&P TSX Capped Energy Index ETF with a ticker of XEG. They seek to replicate the performance of the S&P TSX Capped Energy Index, which of course translates into some very good exposure to Canadian energy companies. Their top holdings include Canadian Natural Resources, Suncor, and Cenovus Energy. At the time of recording, their price was coming in at $18.16, and they have a NAV of $18.17. Their assets under management, $1.71 billion, and they've got a beta of 0.91. That return on equity, 28.89%. Return on assets also looking nice, 15.53%. When we look at their fees, their management fee comes in at 0.55%, and they have a management expense ratio of 0.60%. Their average volume, 1,324,149. Looking to their dividend, they have a yield of 2.91%. It is a quarterly dividend of 17.4 cents per share. Switching to returns, on their 3-year return on investment, we've got a pretty impressive looking 62.29%. Factor in those dividends, and we get a total return of 78.11%. On their 1-year return on investment, that's coming in at 15.82%. Add in the dividends, we get a total return of 19.59%. That 3-year annualized, that's coming in at 21.22%. Energy will be an interesting play in 2025. There is certainly a potential that we could see an early year slump, but as things start heating up with the new government, I have a feeling we're going to see a pretty strong finish in energy in 2025. That's one of the reasons I chose this sector. Moving on to the financial sector, we have the BMO Equal Weight Banks Index ETF with a ticker of ZEB. They aim to replicate the performance of the selective equal weight Canadian Banks Index, providing investors with, of course, an equal weighted exposure to those major Canadian banks. I'm pretty sure I don't have to tell you who they're holding. I think that's pretty self-obvious. They got the big six. At the time of recording, their price was coming in at $42.10, and their NAV, $42.11. Their assets under management, $4.37 billion, and they have a very average beta coming in at 1.02. That return on equity, 15.46%, and their return on assets, 0.81%. Switching over to fees, management fee, 0.25%, and their management expense ratio, 0.28%. That's not too bad. Their average volume, and this is a big one, 2,891,590. Looking at their dividend, they do have a yield of 3.99%. That is a monthly dividend of 14 cents per share. Switching to returns, their 3-year return on investment comes in at 6.34%. Add in the dividends, we get a total return of 18.11%. Switching to 1 year, their return on investment comes in at 22.85%. Factor in the dividends, total return 27.75%. Looking at their 3-year annualized, that comes in at 5.71%. When it comes to the banks, they will have a very interesting year, no doubt, no doubt at all. In fact, they have those pandemic mortgage rates, those very low ones. We got a wave of them coming at the banks, and that's going to be rough. However, they have put aside a lot of money to cover any kind of loan loss provisions that come out of that wave. In fact, in 2024, the initial part of the wave, they did end up having more money than expected, and we can only hope that continues into 2025 because that could be very good for the banks. I think they're well positioned to handle this wave, and that's the reason that they're in our list today for sure. The last sector I selected for today was the materials sector. We have the iShares S&P TSX Capped Materials Index ETF with a ticker of XMA. This ETF provides you with exposure to broad Canadian materials, which includes everything from gold mines and base metals to fertilizer and chemicals. Their top holdings include Anaco Eagle Mines, Barrick Gold, and Wheaton Precious Metals. They also have exposure to Nutrien. At the time of recording, their price was coming in at $22.04, and they have an NAV of $22.14. Their assets under management, 174.76 million, and their beta pretty average, 1.07. Looking at their return on equity, that's coming in at 10.74%, and their return on assets, 6.34%. Switching over to fees, they have a management fee of 0.55% and their management expense ratio 0.61%. Their average volume coming in at 22,806. Looking at their dividend, they do have a yield of 0.793%. That's a quarterly dividend of 0.5 cents per share. With this one, you are here for the growth. Looking at their 3-year return on investment, that comes in at 30.64%. Factor in the dividends, we get a total return of 34.36%. Switching to that 1 year, we get a total return of 29.26%. Add in those dividends, total return 30.37%. Looking at their annualized 3-year, that is coming in at 10.35%. The Canadian material sector is definitely looking to have a strong 2025. We already know the new Conservative government is pretty darn pro on getting our Canadian minerals out of the ground and, onto the market. So I think that's going to look really strong for the Canadian material sectors in 2025, which, of course, is why I chose them. I like these 5 ETFs. And in fact, one of them is already in the 0 to 100K challenge. I do think it will be fun next year to look back on these ones like I do with the stock picks to see just how well they performed. If you are interested in any of these ETFs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your cash on the table. Let's continue that learning journey by checking out this video on, the 5 stocks I picked to do well in 2025. Thank you for watching, and I will see you in the next video.